So I've been following you on Twitter for like a couple of years now, and I've had a great time following your tweets, and I've also gained a lot of knowledge following whatever your content you're posting, and that got me curious about learning more about your journey as an investor and also about real estate investing and everything. So why don't you just start off by covering your story, like what led you up to this point where you're investing in real estate, managing funds for family funds, etc.
Well, first of all, very kind of you. Thank you for having me on your podcast, and thank you for following me for 2 years. I can't believe you put up with me for 2 years. I must be doing at least something okay. So very kind of you in that regard. So a little bit about myself and about my background. I don't like talking about myself too much, so I'm not going to waste too much time, but I'll give you some of the basic points, some of the important points, I guess, dating back 10 or 15 years. So I started in this whole finance industry back in my university days as a trader, back in 2005, 2006. Of course, just in time for the GFC and the volatility and the crashes and the bankruptcies and the losses and so forth. So obviously, over those years, I've learned a tremendous amount, because when there is some kind of event like that, which I guess our generation, financial generation, says that it was similar to the 1929, not as bad, but obviously it had similarities. When you go through something like that, you obviously pay so much attention, and you learn much faster. It's like a German shepherd where his ears just go up and you're just in tune with the markets and you're learning so much, and at that point in time, it was a very huge global macro event. So globally, emerging markets were booming before that, and interest rates were kind of flat, and commodities were in a big boom, and currency, like the US dollar, was very weak. So there was a lot of macro movements leading into this global financial crisis, and then coming out of it, these correlations and risk. And, so I learned a lot, not only about stocks, but also about foreign exchange and commodities and fixed income from the financial market perspective. And, I was learning a huge amount about sentiment and liquidity, about stock market breadth and the internals, the valuations picture, the secular movements, the secular bull and bear markets. I was really focusing on the financial history, in some cases dating back 200 or 300 years, looking at interest rate cycles, Kondratiev waves, Schumpeter cycles for business cycle. I mean, Ray Dalio talks a lot about that as well. So you had all these people who were in the news also teaching us youngsters about all these things that were happening, technical analysis, correlations, macroeconomic fundamentals, all kinds of things. And so, that was a fantastic way to start learning and to get into this whole investment game. By the way, I still trade, not so much this year. From time to time, I trade these days, but obviously, as you were alluding to, I do other things far more often now. I kind of came back out of my semi-retirement in 2019, and I managed to get a 50% plus, I can't remember, 53% or something annual return in trading account. Okay. And by the way, for transparency, I posted every single month on my Twitter, my gains in 2019 and my losses as well. And I also disclosed my whole trading book for that year, every single trade I bought and sold and things like that. But I don't want anyone to think, I don't want to allude anyone to thinking that I can do that every year. And I think you do very good trading when you don't have to trade. And it's kind of ironic, and obviously, the year was very painful and agonizing. Traders have to go through a lot of mental pain and a lot of mental discipline. And I don't really do that too much anymore. I guess I'm stuck with it because I started at a young age when I was only 17, 18. And, I guess it's still with me. I think until my last days on this planet, if I'm doing finance, I'll still be probably trading because I love it, not because I have to do it. I'm fascinated with the market movements. But to cut the story short, I made my first bits and pieces of money trading, I would say, a couple of thousand here and 20 grand there and 50,000 there, and one trade that I made 6 figures on and so forth. You have to understand that I grew up in a real estate family. So naturally, I was always interested in real estate. I was listening in on projects that were happening that my father was doing and so forth, and being around these projects that were going on, attending building sites and so forth. So I guess real estate, I don't want to say is in my blood. I think there's oxygen and white cells and red cells are in my blood, but that expression is kind of funny at times, but I could say possibly there is some part of real estate in my blood. And eventually when I started doing that as well, and that's something that I had in-house, in family house training, I should say, and things like that. My first serious money that I took from, let's say, trading and so forth, my first serious money was made in real estate, where you could really multiply money if you know what you're doing. And I'm sure we're going to talk about that now, but that's a little bit of my background. But I've done all kinds of things. I've traveled to 70 countries around the world. I've lived in Asia. I lived in the Pacific. I lived in Europe. I've been all around. I've had a fantastic time so far doing things while also investing. And I think that balance is also very important. And I think when we discuss some personal finance things, we'll get to that point as well. So that's a little bit about me to start off with.
Makes sense. So what kind of trading do you do these days? I mean, when you do trade, are you a macro trader or are you a systematic trader?
I'm not a systematic trader. I'm a discretionary trader. And I think systematic traders are more consistent and they have their rules. And I'm a gut feel kind of a trader. I'm the kind of a trader that spent like a huge amount of my early years reading books over and over again, in particular, like Reminiscence of a Stock Operator by Jesse Livermore, George Soros' Alchemy of Finance, and Paul Tudor Jones's things, and watching his documentaries and just being in tune with the tape. So when you're wrong, and you have a stop loss and you can be wrong 3 or 7 times in a row. It doesn't matter. You're wrong and you lose small amounts of money. And naturally, I'm a contrarian trader too, so I would swing trade against the herd. Discretionary trader that has a feel of the tape. And then when you're wrong, as I was saying, but when you're right, you nail it and you try to let it run and you let your winners run and you even scale in and things like that. So you kind of try to get in tune with the market. I kind of talk about it like being in a matrix. You plug yourself in and you kind of sit and wait and you're in tune with the market. And sometimes I'm just not in tune with the market, especially now that I kind of focus on, we'll talk about this later, but developments and my own real estate projects. I was just on my phone recently. I have a renovation on the other side of the world and I'm just talking to my builder and looking at demolition that's going on there. I mean, I'm not going to be really checking the Forex market and things like that, but what I trade as well, mainly futures and Forex, really liquid things, and precious metals and things like that. So a lot on the Euro US dollar cross rate and the Aussie dollar, because I'm an Australian, obviously, so naturally trade my own currency, and a lot of the S&P 500 futures, and then gold and silver, like the classic things that people trade. And looking at my journals, I think every trader should keep their journal. By the way, I'm not advising people to trade. Please don't trade. Some of us that fell into trading, or we still like trading, but I think the real money is made investing, and we can discuss that later. But to come back, looking at my journal, my holding periods are approximately between 2 to 3 weeks. So I'm a shorter term trader. I'm not a day trader, and I'm not let's say a macro multi-month positioning guy. I kind of, there could be a news break by the Federal Reserve and the euro could have rallied a lot and there's a huge amount of long sitting in the euro, and all of a sudden the news flow becomes favorable towards the US dollar. So we know there's a short squeeze coming, and that short squeeze could run for 1 or 2 or 3 weeks. And that's the kind of a trader that I am. I look for those reversals that follow through, and then I'm not really trend trading. I'm there at the turn, and then I'm out when I made a decent amount. So I can then go and travel the world and do whatever I want.
Okay. When it comes down to investing, what kind of investing do you do? Do you do stock picking, value investing, or are you a contrarian in terms of investing also? What is your philosophy in this?
Well, when it comes to investing, we have a diversified portfolio. So we focus on a large amount of things. These days is very different to, let's say, 10 or 15 years ago. But the way that we structure our portfolio these days, the way that I run the portfolio is we focus predominantly on stock index funds, on direct real estate deals, and I'm sure we'll discuss these later on. And then we focus on being limited partners in other real estate deals that are run by GPs or sponsors. And then we focus on some alternative investments, such as agriculture and precious metals. In particular, I'm talking about farms. We invest in Australian agricultural farms like poultry and pastoral and lamb farms and so forth. And not crops, which are seasonal and which are very volatile.
Okay.
And we have we do that through exposure through funds and so forth. But yeah, so mainly real estate and stocks with some alternatives. As investors, I don't think we're macro investors, and I don't think we're contrarian investors. I keep a lot of track of that because I think that's important. It's very important to know where you are in a long-term investment cycle. It's more of an art than a science, and it's not, as Howard Marks states, it's not as if we can know exactly the pinpoint where we are in a cycle, but we can estimate the probabilities of it and the risk to reward. You know, I mean, after asset prices have run for 10 or 15 years on the back of monetary policy, it doesn't mean they can't run more, but the potential returns relative to risk decrease and the risk increases. So the longer that it goes, eventually there needs to be some kind of economic reset. And one would have thought that if they let it happen, it would have been this coronavirus downturn. But obviously, we kind of papered over that as well, and we are back to the races. So it's as if we didn't even have a downturn, really.
Makes sense. So when it comes down to, I was actually curious about one of the things you said about investing in farms. So how does that usually happen? I mean, what is the thesis behind investing in farmlands and farms? Right.
So that's a very difficult investment, I think, to make for most people. First of all, the minimum investments are very large, in millions of dollars. And the thesis behind it is basically, from my perspective, is that this is the Asian century. And all of the research that I've made leads me to believe that. Even if Asia is not going to dominate the whole century, they have an incredible demographic tailwind occurring, and let's say for China up to now, and then for India, Vietnam, Bangladesh, several other places as well, like Indonesia, into 2045 towards 2060. So there's a lot of tailwind there. And I think on a purchasing power parity, if you can use that method, the middle class in Asia, the whole Asia Pacific actually, but especially emerging Asia, is rising. You know, there's estimates that from half a billion towards 1 billion people in the purchasing power parity middle class ranking, we are moving towards 3 billion people. And obviously there's going to be a huge amount of demand for food, in particular protein-based diets. People in the East, people in the emerging world want to eat more and more like people in the West who have been eating in this sort of, let's call it affluent or luxurious ways with very rich diets, because they had the capacity to do so, they had the income to do so, they had the living standards to do so. And Australia tends to be right on the doorstep as a major exporter to countries like Japan, China, Indonesia, Vietnam, India, and several others in the region. And it's a massive demand because of the massive population. So we've been investing with a certain couple of funds that focus on not just the technological advancement side of, let's say, agri-tech, and buying owner-managed farms which have not been performing so well, and then really improving the services and the net operating income of those farms, but also starting new assets, developing them, stabilizing them, and then growing them. Because of such an incredible demand, you know, it makes a lot of sense to invest from the secular point of view, but at the same time, financial assets are incredibly expensive, and you know, stocks are at their 95th percentile evaluation dating back 150 years, and bonds are at their 1st percentile of the low yield. Like, it's 150-year low for the bonds all around the world. In some cases, it's negative yields and so forth. So extremely expensive asset classes that are traditionally make up the portfolio, but then agriculture and land everyone's urbanized into the cities. I mean, it's happening in India all the time. It's happening.
Correct.
It's happening in Australia. 85% of the population in my country lives in 5 major cities. So no one wants to stay at home. No one wants to stay at the farming homes and continue to work in a family business. So the valuations have dropped, and it's a massive opportunity. So you can buy these asset classes with incredible yields as long as you have the right people to run them, or you participate in a fund who has a track record of running it. So valuations are extremely attractive. Yields are fantastic. Potential returns are incredible, possibly double that of the stock market. Stock market's average, I should say, on any given year. Like if you bought the stocks at the March bottom and held it till now, it's 50% return. But doesn't happen every year, of course. So I think agriculture is a fantastic investment. And finally, you know, another point apart from valuations and the demographic tailwinds and the demand supply story and the fact that it's a forgotten sector, I would also say, you know, security of food is very, very important for a lot of countries as well. So there's going to be a lot of mingling geopolitically regards to that. And it's also a fantastic inflation hedge. So I think in case central banks continue to print money the way they're doing right now, I don't know when, but somewhere along the lines, inflation could happen and it could be devastating. I think you want to own real assets at that point in time, you know, especially because another point, maybe point number 8, is that the correlation between real assets and traditional financial assets is not negative or positive, it's just not correlated. They just do their own things in their own ways based on fundamentals. And, you know, a great inflation hedge, it could be a very, very smart way to play the next, let's say 2020 is the next decade ahead that's coming now, considering how central banks are acting. I mean, if I took you back in time to when I started, and I said to you at the beginning of the podcast, I started in 2005.
Yeah.
If a central banker was to say, somebody like from Bank of Japan or even Powell yesterday, if they were to say that that they're not out of the bullets and they can print unlimited amounts of money, if I took you back just 15 years and a central banker said something like that, I honestly believe that they would have been arrested. That was like, it would have been a legal thing to say. Yeah. But slowly over time, due to the circumstances that we're in and due to the massive amounts of debt levels that we have, the goal is to inflate this debt level, and they're going to print, and they're going to run the printers as hard as they can.
Makes sense. So how did you actually start off with the real estate investing, and you know, when did you start off? What were you looking for when you started?
I didn't start like normal people, because I obviously, you know, when a normal person starts in a certain sector, like I started normally in the trading game, you start from the bottom and you start learning. For real estate, it's a whole lot different. I already started in a real estate family. I mean, I started on my own. I've done my own projects, but I've started in a family which was already doing in-house architecture, in-house construction, importing its own materials, and focusing on, my family business focuses predominantly on single family luxury real estate. So we would buy either beautiful apartments or a land which would build something on, or we will do the same thing for the clients that approached us. You know, a client will come and say, well, I just bought this old apartment in the center of the city and it has a beautiful view of the sea, or it has a beautiful view of the river and or the mountains, or if you're in Vancouver or something like that. Obviously we're from Australia, but we would like for this to be modernized, and we would like it to be a one-off apartment. And look, we've seen your previous track record and some of your work, and let's see if we can work together, and we would love to help us to renovate this apartment. So we work either with one-off clients like that, high net worth individuals, or we do our own deals. So that's how I started. And so naturally progressing from there, I still continue to do that. And that's one of 4 key strategies that we focus on. So if we take a step back and discuss what sort of real estate opportunities I focus on, let's first, for the people that are listening, because real estate can sometimes be a difficult way to talk if people are just used to stocks. Let's first understand the difference and similarities between the 2 asset classes of stocks and real estate. And I'm going to try to attempt to, you know, make it a like for a like so people can understand it better. Okay. So stocks are basically businesses. So businesses in real estate, right? So when it comes to businesses in real estate, you have two ways of exposing your capital yourself to these markets. You can do it either via equity or via debt. And I'm pretty sure that makes sense.
Yeah.
On top of the exposure, you have, let's say, several strategies, or you have many sub-strategies, but several strategies in each asset class. So let me try to keep those simple. So for example, let's think about it. In stocks, because your personal finance advisor might say this, in stocks you have a dividend strategy which focuses on income. I'm just trying to simplify it. You have a traditional strategy that buys the index fund or the blend of all the strategies, you know, a market cap weighted index fund. And then maybe you have the growth strategy, which focuses on capital appreciation, or you have the small size strategy, which focuses on small caps, which is also capital appreciation. So, you know, 3 tiers of risk, and one is focusing on income, another one capital appreciation, and somewhere in the middle you have a balance. Well, real estate is quite similar. You know, we have investors which focus on what we call core. Core is predominantly a cash flowing strategy where you own a certain asset that's already kind of stabilized and finished, and you're not going to touch it. And it's just spitting out cash flow, and it has a certain yield. And usually the leverage is not very high. As soon as leverage becomes higher, that's not a core strategy anymore. It becomes like a core plus or something else, not to complicate things. So that's core. Then the balance of the two is like a value add, where you can improve a certain asset class, and then the purpose of improving is either to force its appreciation, because if you let's say, for example, I'm doing this right now. You buy an apartment for €1 million, you put in another 200,000 euros. It's a luxury apartment. And then you can sell it for 1.5 or 1.6. So basically, you are forcing the appreciation to go up without the market actually moving, which is kind of different to the stock markets, because you can't force appreciate a stock. It has to actually move. You can do that to increase the appreciation, or even to increase the income, where the rent, now that you've renovated the apartment or the whole building or the office or whatever you're focusing on, now it can rent and produce a higher form of income. And then finally, what we focus on, we don't focus on those two, we focus on opportunistic strategy, which is similar to growth in investing. And so what is opportunistic real estate? That's a little bit riskier, but also higher rates of return. And I'll explain why we only focus on opportunistic later. But basically, ground up developments, repositioning of buildings, let's say from office to residential or something like that, non-performing projects, non-performing loans or something like that, and distressed real estate where it's selling because there's some type of owner distress or motivation to sell, or these kind of things. So I would say, that's kind of what we focus on when it comes to those three strategies. So in summary, these strategies, you can either gain exposure to them, as I said, via equity. So that's like being a shareholder. Real estate folks actually call them limited partnerships or LPs, or you can gain exposure as a lender. And we also do that too. That's where you are investing into debt. Okay. So just to talk about 4 ways that we invest into real estate very quickly. Developments, both on the equity and debt side, but 90% of the time on the debt side because of the asset protection. Okay. Distressed opportunities, mainly distressed equity. That's an opportunistic style of investment, just like developments. And so we prefer to get deep value discounts here. It's not always easy to find, but once in a while you'll find a motivated seller. Just wanted to mention with the first one, development projects, when we focus on debt, just to clarify for people, it's either senior or mezzanine structure. So senior or junior debt, and they have priority over equity. The third strategy that we focus on, and we kind of been quiet in this strategy, but that's multi-family cash flowing real estate, mainly in the US, because that's a unique asset class for the US. That's basically, while the first 2 strategies I talked about are opportunistic, that's mainly a value add strategy where a group of people will come together as limited partners. They would give money to a general partner. He would go and use that equity plus some bank debt, and he would go and buy a big building that's cash flowing, and that he would basically improve it slightly or meaningfully, depending on what it needs, whether it's classed A, B, C, and whatever they do in America. and then, we would try to increase the rents and the valuations and so forth. And you get a whole lot of benefits there, including appreciation, cash flow, depreciation, other tax benefits they have in the US and so forth. Things are a little bit, valuation-wise, things are a little bit too rich for us there. So we pulled back from this strategy over the last couple of years. We're kind of waiting for some kind of mean reversion. People would argue because interest rates have fallen so low that the spread between what this real estate earns and the interest rates is a fantastic spread. It's actually, the asset class has improved, but we just think that the interest rates are officially capped there, and we don't know for how long. The Fed tells us for the next few years, but we don't like taking those kind of risks where we are tagging along and investing only due to one fundamental reason, that the Fed has a back. Valuations are very expensive, but the Fed has your back, so invest anyway. We don't need to do that kind of investing, and we don't want to. Okay. So that's a little bit. So 4 strategies, the way that we focus on real estate.
When it comes down to development, what kind of development do you involve in, and how do you source such deals in countries that are not your native, like Australia or Hong Kong?
Sure. Well, that's a really good question. How to source deals is a whole podcast on its own, I believe. And I recently started a service called the Atlas Investor, where the deals that we are looking at all the time, we are actually helping individual investors, high net worth investors, small family offices and so forth, participate along with us and invest with us into deals that we think are very attractive. But when it comes to developments, we mainly focus on residential developments. The outcome that we are usually looking for is the following. We want the developer to have a very good track record. That's first and foremost. And predominantly, they've been around for at least one cycle. So there's a lot of people who are now operating in real estate and on the trading desks of the stock markets and big investment banks, who started in 2009 or 2012, somewhere at the bottom, and they haven't seen a proper downturn or a recession. That doesn't discredit their capabilities, but it just, experience is a very, very useful thing in life. So we tend to operate with developers who have a fantastic track record and have been around for more than one cycle. So let's say at least 20 years, 15 to 20 years at least, but maybe even dating back to the previous cycle. If you think about real estate, there's been 2 major downturns over the last 3 decades, the 1990 downturn and the 2008 downturn. It's fantastic if we can find and team up with a developer that's gone through both of those downturns and survived and has a great track record. In other words, never defaulted, clean track record. But if we can't, at least if they were tested in the GFC, that gives them a lot of merit. So that's number one. Number two, the developments we focus on need to have very good locations. Not only are these locations need to be, let's say, central in some nature, where there's a high demand and limited supply, but also they need to be in good economic countries where there's good judicial systems and protection of rights and land. And we usually choose Anglo-Saxon countries. So we've invested before into the US, but predominantly we are from Australia. So we invest in Australian market, and we have recently seen a lot of opportunities, and thus our exposure has risen in the UK market as well. So, I think in the world of real estate, the 2 strongest, most liquid markets in the world have always been Manhattan, New York, and London, let's say London, UK. And we focus on London a decent amount. I think London and Manhattan are both going through a massive downturn now, and they're suffering, each in a different way. But that doesn't deter us, and we think that there is a huge amount of opportunities and a lot of pockets there. Another thing that we look at when it comes to real estate developments, as I said, we like to expose ourselves to the debt side, so senior debt, but predominantly mezzanine debt, because some of these developments are so big. Senior debt tickets range from 5 to 50 million pounds as for one investor, usually a family office or financial institution or a bank, or a credit fund of some kind. And then the mezzanine debt, you can have several high net worth individuals or family offices invest, and each of them would invest $500,000 to $1 million or something like that. So mezzanine debt, obviously, for those that don't know, is a bit of a hybrid between the two. I'm not going to get too much into it, but basically it has the protection that's similar to senior debt, but it's subordinated. In other words, second charge, second priority to senior, but it has better protection against equity. So we don't really like to do joint ventures or GPLP structures where we team up with developer. Developer doesn't have any skin in the game. They put in a tiny bit of money, and then all of the limited partners put in a lot of money, and then they get a bank loan, and then they develop it. We prefer to have, a better protection than that, and obviously leverage is a key component. So track record of developers, location is very important, and then we're also looking at quite a lot at the leverage and what we call a capital stack, which I just touched upon without getting too much into it.
Makes sense. And when it comes down to distressed real estate or non-performing assets for different banks and institutions, usually the country locals are preferred, right? Like country locals get their access to such deals first. How do you, remaining in Australia or Hong Kong, get access to such deals in other countries?
I'm not so sure that country locals get better access. They might have some better knowledge, but I'm not so sure. So the way that generally that we've developed our network base is through all the typical things, attending seminars, being referred, referrals by clients or other families, or referrals by accountants or lawyers. Networking, even social media has played a decent amount there. Just cold reaching, talking to people who are in the industry and so forth. And I think over time, over years, there is a potential to develop fantastic business relationships. I think what's important there is you have to be able to, nourish these relationships. You have to put in a huge amount of effort into them. And they don't just cultivate from nowhere. So unlike the stock market game, real estate game is very much a relationship building game. So as I was saying, when it comes to getting the connections, I think basically you just have to cultivate these relationships. And unlike the stock market game, as I was previously saying, real estate is really a game of cultivating relationships and knowing people and being able to get off-market deals or having the first mover advantage. Referrals is a big one as an example. And when the right people refer you, it doesn't matter what the local people are doing. You might have the first mover advantage, and you might have local people that help you out, even if you're not a local. Like we have a local accountant and a local lawyer in the UK, and various other things like, let's say, I don't want to get too deep into it, obviously, but credit originators, developers that we met and so forth. And if we have proved our track record, or if we worked with them before, and if we disclose to them that we're open to doing something again, I mean, I don't think that they're going to have a prejudice on us because we are not locals, and they might contact someone that's local over us. I think it's more about cultivating relationships.
Got it. When it comes down to distressed deals, what kind of business model do you look for in order for a deal to be profitable, or in order for you to go through with a deal?
Yeah, that's a very good question. I think it just comes down to price. I think it's very, very different to, let's say, the stock market, where people are looking for a turnaround story in a company. In real estate, with distressed deals, we're usually looking for some type of a motivated seller. A great deal usually starts with a motivated seller. So let's focus on the London market, and let me give you an example so I can explain that in a better way. Right now, official statistics are stating that the London market is possibly down maybe around 5 to 7% at most. And the slowdown has been going down since Brexit and the change of the stamp duty, which is the property acquisition tax, which is quite interesting because that's been going on for 4+ years now. So the prime market of London, the luxury market, which the Brexit has really impacted, that's down by 15% or more, which is your prime luxury areas, which we don't really participate in too much. On the other hand, the rest of the markets around London, the boroughs, which are predominantly, demand and supply in the local market, they are kind of flattish. Some are down and some are up. So, on the surface, it looks like there's not that much distress going on. And a stock market investor would say, because they're trained to look at the broad thing, and they would say, well, the index is not down. So what am I going to find there? I have to go and stock pick things. And I basically think that that's the same way as well in the distress game as well. When the demand pulls back and liquidity pulls back in the real estate market, because, by nature, private investments are illiquid.
Yeah.
People who don't need to sell are not very worried. Prices are down 5%, they're down 7%. It's not a big deal. They're up 30 or 40% over the last 5 years or 6 years. So it's not a big deal. But people who do need to sell, who are motivated sellers, who are forced to sell, that's where there is big discounts and distress. And in particular, it's those people who have been doing developments in not so great fashion, where they've overextended themselves, where they had very high interest rates on construction loans, which is basically senior debt, or where they had too much volume and they couldn't exit on the time that they had to sell, or they had a default, or there could be a marriage breakdown and divorce going on, and there's issues with the landlord's health, and he's selling some old buildings and he needs capital fast. Whatever the motivation is, whatever the distress is happening, you basically come in and you offer something that's a very, what we call a very low offer, or a low ball. Most of the time, these offers don't get taken, but once in a while, when you find, for example, with developers, some of them need to get rid of, let's say, out of a building of 20 apartments or units, they need to get rid of the last 5 to pay back the bank debt, or pay back the LP investors. And they just haven't been able to do that. So they would consider actually taking a loss for themselves just so they can pay back this debt. And they could reduce, if you buy in bulk, they could reduce all 5 units or all 7 units by, in some cases, 25 to 40%. Does that mean the prices of London, of that barrow, have fallen 25 to 40%? Definitely not. And that's a distressed deal. Within 6 months, you can go back to the bank, especially if you've rented these apartments and they're now producing cash flow, and the bank will probably value them, conservatively, but at the level where they should be with the rest of the area, based on comps, real estate comparables. At that point in time, you can do a cash refi and pull out half the money that you invested, and you still have an enormous amount of equity left, not a lot of leverage, and you have a cash flowing real estate deal. And then you can go and target something else. That's the basics of distressed opportunity. I think in real estate, it's quite simple. You want to choose good locations that, have very good transport links, amenities, where economics and demographics in that area are very sound, job prospects are very sound as well. And then you want to look for, I guess, the worst situation in a great suburb, where somebody has some kind of family distress, health distress, financial distress from the bank, and it's about negotiations. 9 times out of 10, probably your low ball won't be taken because people know that you're taking advantage of them. But they've got themselves into that kind of a trouble, and I guess you're kind of an opportunist who can bail out the situation, and 1 time out of 10 people will take that offer, and you're going to get an incredible deal. That's what it's about. It's not about the volume. It's about getting a fantastic deal and you walk away with some incredible gains.
Yeah. So which kind of countries do you avoid for these kind of distressed and non-performing asset kind of deals? Like, do you do these in...
I was going to say, I don't want to give the intention that we are investing all over the world. Okay. We definitely have exposure in different countries, but I would avoid 99% of countries. That's the simple answer. We invest in the US, we avoid Canada.
Okay.
We haven't invested a lot in the US recently. We invest a decent amount in the UK. We've invested in Czech Republic, just one country on continental Europe. And we've invested before in Australia, but we haven't invested yet in New Zealand. But maybe one day we will consider that. It's quite a small market. I don't want to give an impression that we will go everywhere and hunt for things, but I have also lived in Vietnam before, and we have purchased some condos. Personally, I purchased five condos with another partner, and we've done pretty well, but it was more of a speculation. I wouldn't really say, we were betting on the market opening up a massive, because we were one of the first people to start looking at that with some other friends in 2016, just a little bit of background story. And Vietnam opened up investments to foreigners. It's kind of a risky proposition, obviously, going into an emerging or a frontier market. And, you know, we were anticipating Hong Kong, Singapore, Taiwan, Japanese investors, South Korean Seoul investors, all with very high income and very expensive property markets of their own, to flood into Vietnam, where the price per square foot or the price per square meter, respectively, would be 500 or 5,500 in their countries, all the way to 10 to 12,000 per square meter, 1,000 and above per square foot. And they were flocking into Vietnam where the prices were 1/10 of that, or even in some cases, maybe 1/5 of that. And we were kind of anticipating a catch-up, not a complete connection where the prices would catch up. Maybe that will happen over the next 20 years, but we definitely thought that people would diversify out of those Asian countries, and that's what actually happened. So when we bought some of these investments, they ended up doing amazingly well just on speculative price appreciation. But that's something that I guess you have to time, you have to read the cycles, and you have to take a bit of a chance. And you also have to make sure that there is some sort of a margin of safety. We didn't think there was a lot of downside left when you're buying properties for $150 a square foot. And, you know, how much lower could they go? So, I mean, possibly they could still decline, of course, but that was like the rock bottom in 2013, 2014 in Vietnam. By 2016, when they opened the market, it already started moving up. And now it's gone up in some cases so much, so we're not really investing there. But to get back to the point, I don't want to give an impression that we're investing everywhere. We are diversifying in 3-4 countries where we see, solid rights and property ownership rights and judicial system, protection of assets and so forth, where we have good connections or a good edge of some kind, where we can actually get the deals moving in our favor and get a good rate of return. Also where tax benefits are enormous. Like, for example, if you live in the United States, you have fantastic tax benefits for yourself in real estate. But if you are investing as an outsider into the United States, it's far better to invest with debt than equity, in my opinion, because the IRS has a special, I'm not going to get into the technicalities of tax, but they have a special IRS code, but a special way that they treat foreign income that comes in and lends money. You basically pay no taxes on withholding interest, and you can get your principal and interest in full back home. And if you are investing from a country which also doesn't tax interest or dividends or something like that as well, no withholding taxes on the receiving part, you end up with a no tax on both sides. And also when you're investing in debt, you have that downside protection. If you're investing in senior debt or mezzanine debt, you have a far better chance of seeing your principal and interest return than you are with equity, all else being equal, obviously. So, I think countries that have very good taxes also appeal to us as well, and several other things. Like we don't want to go to Dubai, where supply overstrips demand by 10-fold or 20-fold, and the prices have been just sinking down all the time, and it's endless amount of cranes, and people are just building forever. And also, we don't want to invest in India. No offense, by the way, but we talk to some well-to-do people from India, and it's a very difficult market from what we hear. I mean, first of all, the bureaucracy is incredible. The laws are a headache. I mean, the courts don't work. We would never consider it. And then on top of that, the rupee has been extremely weak and constantly sinking. So, you just don't have a sound currency, sound court system, protection of rights and land rights, strong tax advantages. These are the kind of things that we have a checklist on. And then we have to actually go there after we do the macro. We have to do the micro. We have to actually meet the right people on the ground. They will open doors to some of these opportunities. And then we have to do relative valuation. Like, are we wasting our time in this country making 10% per annum when we can be making 20% per annum somewhere else? Like, what's better?
Okay. So if you are in a country, if you are investing in some distressed property or property development in US or UK, how do you manage, like when they are a cash flow generating property, how do you manage remotely? What kind of process do you use to manage the properties remotely?
Well, majority of the time we are not general partners, we're not sponsors, we're not doing direct deals in these countries.
Okay.
We are doing, we are one of the investors in this big limited partnership or a raise. And we are on the passive side. Our job is not to worry about the property. Obviously, we do the due diligence on the macro side, macro meaning the country and the city, and the micro side, meaning the actual deal itself, where it's located in the street and the suburb and so forth. And we look at the financials. You know, you have to really get to the due diligence part. But we look at the financials. We look at the demand and supply, and predominantly the number one thing that one should be looking at is who is running this project. And because we're going to be passive, who is actually active? And you know that this is the sponsor of the GP. What is their, once again, what is their track record? How long have they been around for? Do they have a clean track record? How many times have they defaulted on a project? We don't work with people that let their LPs down, you know, and they say, oh, that was a bad project. It happened in 2008 and I walked away from the deal and people went bankrupt. That's not a good sign for us, because when the going gets tough, the tough get going. Correct. That's an old famous quote. But when the going gets tough, the weak GP, the one that doesn't have alignment of interest with you and potentially doesn't have proper skin in the game in the deal, will just walk away from the deal because they don't really care. So for us, we are investing mainly passively, you know, and we have to more so analyze who is the sponsor of the GP and do a thorough due diligence check on them and vet them and their previous track record, more so than the deal that they're doing, and make sure that we have an alignment of interest, you know, that the way that they're going to get compensated. That's why we like mezzanine debt. It's not just the protection, it's the alignment of interest that people don't understand. Mezzanine debt exits before equity. So for the equity guys to actually exit, they need to pay us. We are their liability. Okay. So they need to pay off their debt first and the interest on that. And only then they get to see their profits. So therefore, what's good for them is good for us. For them to get their hands on the money and the profits of this deal, they will have to pay us. And we don't like to do deals where the fees are very high up front, because then they get compensated and then it doesn't really matter how things go. We want to make sure we have a performance-based system where they get compensated with a meaningful profit share at the end. But if we're sitting on the mezzanine side, they have to pay off their senior and mezz debt first, and then obviously they get compensated. So they have to do, naturally, by doing right for themselves, they do right by us. And that's a fantastic alignment of interest.
Okay. So apart from these real estate deals and equity investing, and agriculture, of course, what other alternative investments do you invest in?
Not a lot, really. We don't touch private equity. We do have physical gold that's stored in one little country in Asia, where they have fantastic laws, once again, tax laws and expropriation laws. So they kind of expropriate the property from you, and it's a financial center. So we hold some physical gold, and that's not really an investment.
Okay.
That's more of insurance policy, because you never know what can happen. You never know what can go wrong. I was originally born in Croatia, former Yugoslavia, where there was a war and a hyperinflation, and I witnessed all that before the age of 15. Okay. And I know that it's possible that it can happen. But a lot of my friends in the West, where I eventually moved to Australia and I grew up and I had schooling in the West, a lot of my friends, they cannot fathom something like that happening. You're obviously from India, so you could, and you understand that. And on top of that, you guys have an incredible culture with gold for a long, long history. And I admire that. Now, I don't think gold should be a massive part of somebody's portfolio unless they're a really good trader and they know when to buy gold and when to sell. Okay. But if that's the case, by the way, and you're watching this podcast, make sure you call me first so I can also buy and sell and make a lot of profit alongside with you. But jokes aside, I think it's an insurance policy, because gold is not a liability to anybody else. So yeah, I think mainly we like agriculture and we like real estate on the real asset side of things, and then we like the stock market. And we have a basic investment philosophy of when it comes to picking these things, and I can discuss that with you if you want. Just a natural procedure of how we invest and what we're looking for.
Okay, so when it comes down to equity, do you usually go to cash while you feel the valuations are stretched, and then deploy money when the market is in a downturn of sorts?
Yeah, so obviously we don't have a fund.
Okay.
I guess one can call it that. If you really wanted to call it, you could call it a private fund. We have several families that invest together,
Okay.
and some people call it a family office, but I really hate that term as well. It's become such cliche. There's no offices. There's no people running around with papers and fax machines or anything like that, and you know, some scene out of a movie.
Okay.
So we co-invest. There are several families, and we co-invest the capital together. And I deployed this capital into various asset classes.
Okay.
We don't have a benchmark to follow. We don't need to go to cash and then wait for opportunities.
Okay.
We're not really in a hurry to outperform anyone, or we're not managing anyone's money, so to speak. The way that we really do things, well, I deploy capital into stock index funds, our own direct real estate, other people's real estate deals, whether they're developments or multifamily or distressed, as I discussed before, and into some alternative assets such as precious metals and agricultural assets. So what's our investment mandate? I'll try to simplify it. So historically, you know, index funds are a pretty good place to start for most investors. And I think whether you are a sophisticated investor with a lot of money or somebody starting out, I think this philosophy works. Like, it's a basic philosophy for most people. I think even if you have a huge amount of money, what I'm trying to say is you don't have to change the simplicity of things. You know, simplicity is just like priceless, in my opinion. So we start with index investing, let's say in the US, historically, or globally as well, but historically it's had a very good thing going for it, and that's called survivorship bias. I'm not going to get too much into that. Your audience can Google what that means and so forth.
Yeah.
As long as you don't panic during downturns, you shouldn't experience permanent loss of capital. And that's the key. You know, when you listen to people like Charlie Munger and Warren Buffett say, rule number one is don't lose money, and rule number two is don't forget rule number one.
Yeah.
That they're talking about not losing your permanent capital, like no permanent loss of that capital. So obviously you have investor psychology, or investor mindset or mentality, the panic and fear, which can, and that's a completely different topic. People can panic and sell their index funds at the bottom or any asset holding at the bottom. But if you don't, index funds will perform pretty well over very long periods of time because they have survivorship bias. As companies become irrelevant, they're moved out, new companies are added. So over time, you know, index funds have done pretty good. So that's kind of how we start. We start at that level. And then we also look at history and we say to ourselves, well, generally size or market cap, that's a big advantage in factor investing of index funds. Okay, so we prefer, this is just our mandate, other people can do it their way, but we prefer small cap companies over large cap companies because historically over 20, 50, 150 years of data that we have in the US predominantly, small caps have outperformed large cap companies. You know, and like I said, there is data there for people to have a look at it. So as an example, you know, a US small cap ETF over the last 20 years has produced a 10% compound annual growth rate.
Okay.
And there's a zero chance of permanent loss of capital, in our opinion. And there's actually real passivity with this. You're actually truly passive. And there's also liquidity, which alternative assets don't give you. There's also a potential with that liquidity to do contributions to beef up those investments. So every time there's some type of a setback and the prices fall 15 to 20% away from the 200-day moving average and it's overstretched to the downside, it doesn't mean you're going to get a perfect bottom, but you can add buy low and sell high kind of a thing. You can add when it's low, and when it's eventually it will mean reverse. So you can also do contributions. So that's our starting point. That's our benchmark, if you will. We kind of say to ourselves, well, the small cap ETF index funds can produce about 10% per annum. So the most important thing then is when we are looking at alternative assets, and when we have, people pitch us the deals and give us a deal deck of things, these sponsors and general partners, whether it's for real estate or other private deals, we ask ourselves, can these deals outperform index funds? I mean, if you can't outperform an index fund with your trading, being active, or with your selection of alternative deals, why are you even bothering? Or with stock picking. if you can't even outperform an index fund, which is a benchmark for everybody, I guess,
Yeah.
You shouldn't even bother. And remember, by the way, with private deals, you can lose part or whole of principal.
Correct.
A GP or a sponsor could also run a scam or a fraud. You know, nobody's going to run a fraud on a Vanguard small cap ETF index fund.
Yeah.
And then you also don't have a lot of liquidity, and therefore you can't exit very quickly if you need cash.
Correct.
Not that I'm taking anything away from either side. You have to understand both of these, let's say, weapons should be in your arsenal when you go and fight the financial war. Maybe I could have used a better metaphor. We don't need wars, but yeah. So, you know, there are different strategies. Okay. So our investment mandate by default, we invest capital into index funds. And of course, we hold a decent amount of cash if we think valuations, to answer your question, are high. But there's also relativity, like US large cap growth stocks are very expensive. And that's what's making these indices look very expensive by default. But then small cap value is very, very cheap. So we might allocate something there. Even though small cap value and value in general has underperformed for so long, these index funds have still averaged 10% compound annual growth rate since the year 2000.
Yeah.
So over the last 20 years. So it's been very good. And then obviously with the cash and with other money, we start to entertain possibility of investing into alternative opportunities that exceed that rate of return. But the key here is without taking too much risk. Of course, you can find a plethora of alternative investments where the target return that's promised is incredibly high and they're going to use a huge amount of leverage, but that's not how we want to do it. Because once again, if we come back to the point, that will increase our possibility of having a permanent loss of capital. And we don't want to do that. So what do we entertain? We entertain alternative deals approximately, this is just a range, where we can make at least 15% per annum unlevered and possibly 20% and over with some leverage. But also it should be some margin of safety. So, you know, these can be, I just discussed agriculture, just to give you some transparency. Last year, our agricultural fund returned 22%.
Okay.
He did it with 1.3 times gearing. Now, Warren Buffett runs the Berkshire at 1.3 times gearing as well. Yeah. So if he can do it in the volatile public space, private assets don't have volatility and gearing is far better. And it's very low cost of debt as well. So gearing chicken farms, beef ranches, lamb farms, and timber plantations at 1.3 times is not a crazy type of a risk. And returning 22% per annum is a fantastic kind of a deal. Mezzanine debt investments. Because we are leveraged to somebody else, we are lending money to somebody else. We don't have leverage like the equity investors do. You know, equity investors have a down payment, they borrow money from the bank, and they have their equity, which is leveraged or geared, and then they're going to end up making a huge amount of money because of that gearing. It kind of makes, you know, a Toyota Corolla sound like a Ferrari in some cases, you know, because you've just beefed it up. Mezzanine debt is the opposite. We don't borrow money when we invest. We are the lenders to somebody else. So when we return interest rates of 15 or 17% per annum, in a mezzanine debt, junior debt type of a strategy, we are actually, you can't compare apples to oranges. You have to compare apples to apples. It's actually unlevered return of 15 to 70%. It's beating even the index funds, because even though you don't lever the index fund, don't forget that every one of the companies, let's say S&P 600 small caps, a lot of those companies have debt. They already geared themselves up. So if you gear them up even more with the volatility, chances are you can actually go bust, especially in a downturn like COVID or GFC or something like that. So in summary, you know, our investment mandate is to allocate to alternative assets when there is a very high rate of return.
Okay.
And considering the risk, you know, we have to be compensated for the risk that we're taking. We want to make sure that there's a margin of safety. There's a downside protection, and these are real, not just theoretical things that people in the stock market say, well, I bought a company with a moat and it has a margin of safety. No, I'm talking about a real margin of safety that you can actually tangibly understand, where if the prices of property fall 25%, I still break even. because the equity gets wiped out and the mezzanine debt doesn't. That kind of a margin of safety. We also want to be very conservative with gearing and leverage. And we want to make sure, as I said once again, that the sponsor or the GP has at least 15 plus years or 20 years of experience. We kind of skip through those who haven't been around prior to GFC. And if we can't find those sort of deals, and we can't find them consistently, since it's very hard to do so, by the way, it's not easy to just go out, and these great deals don't fall into your lap, then historically and theoretically as well, we allocate to small index funds in the meantime, and we also hold some cash and we wait. So that's basically in a nutshell our investment mandate, and I really hope that helps a lot of people who are listening.
Yeah. Have you also looked into cryptocurrencies of late? And what is your opinion on that space currently?
I can't say I'm an expert in this area. I do look at it and I track it from time to time. I don't know much about it, and I've learned to stay in my own lane when it comes to giving advice. So I can't comment a lot. And I think my favorite answer when a question like this is posed to me, any sort of question, and just with cryptocurrencies, and my experience is not there, is I usually say, I don't know. So I couldn't really comment on that. It's a very interesting proposition, and I'm watching it play out. I'm not 100% sure whether it survives and thrives, or whether it doesn't. I'm not sure how the governments themselves are going to, whether they're going to implement some kind of cryptocurrencies, or whether people will continue to use, the main one is Bitcoin, and people talk about its scarcity and inability to produce more of them, and all of the advantages and disadvantages that Bitcoin has. So I'm just kind of like a spectator at the moment. I'm watching and learning.
Got it. So I have also been following your personal finance tweets on Twitter. So you have a different opinion about saving versus creating income, cash flows, and all. So what is your take on personal finance for? Yeah, I've seen your tweets, and you've been very opposed to saving and frugality mindset, and very much towards create more income sources, create more cash flows, and create your income, raise your income levels kind of a mindset. So where does this actually come from, and how did you approach this initially?
Sure. Well, personal finance is something that I give a lot of thought and a lot of reflection on. And maybe we backtrack and I give you my unique story in a sense of how I think about it, and how I started and things that I went through and why I'm actually trying to help people.
Okay.
Because generally speaking, money is a personal thing. So personal finance is very personal. Obviously, each of us has a unique financial target as well as a lifestyle choice. We have to start with that, I think, at the top. Not everybody wants to live like me or you and like somebody that's watching. Everybody has a different, people ask you what's enough. Everybody has a different target in mind. Some people don't have targets. Some people don't, it's not the net worth is not the only target. It can be a passive income target, and everybody does it differently. So in general, the advice that's applicable, I think, to most people at the beginning is to master the 3 key money skills. Okay. I call them 3 key money skills. I call them disciplined spending, forced savings, and wise investing. Now, investing we talked about for the whole podcast already, so we're just going to put that aside. Let's talk about personal finance of spending and saving. I believe these are actual skills. So I think when we're young, assuming that we're starting out from nothing, like the way that I did, I think living below your means is a sound piece of advice, honestly. And I also think to a degree, frugality and focusing on high savings rates, which is kind of connected to these FIRE movements and things like that, has some merit when you're just starting out. And it's good to build that discipline anyway, even if you participate in the FIRE movement for a year or two and things like that. Whatever you earn, you need to spend less, obviously, by disciplining yourself and building these positive and reinforcing habits. Habits are built over days, weeks, months, and years. And I think this is best done when you're doing your own budgets, and there are a variety of ways that people can execute this. Some people do the cash envelope method for budgeting. Some people track their finances weekly, and if they start going off course, they would adjust straight away with their compass if they're sailing in the wrong direction or overspending. And some people keep a limited amount of money in their checking account. So if they overspend, they must wait for the next month and they can't buy anything more, and they punish themselves in that way. So I think, people need to force themselves to save on top of that as well. And I think forced savings can be done by, obviously, I'm just covering the basics, automating percentage of weekly or monthly salary into your account. Also, there's another way of forced savings, actually, which can basically be the fact that you pay down your mortgage. Each monthly repayment is that portion, one portion of that goes to the interest and the other one to principal pay down. And of course, you don't see this money in your hand, and people say, well, what's the point? It's not actually in my bank account, but you're actually building equity and your net worth, So I prescribe to all of those things. And I also prescribe to, speaking of net worth, I also prescribe to tracking your net worth. I think it's another healthy habit, as research shows that people who actually track their net worth on a monthly or a quarterly basis or whichever time frame, they tend to do better than others. Since you start projecting where you will be in a year or two from now, if you continue to do very good things, and then progress remotivates you, gives you more ambition, reinforces the good habits. And also, research shows that your brain starts finding ways of how you could speed up the process and increase your net worth. So all of those things that I've covered, yes, I agree with them. But here's the change that you mentioned. I believe as we age and as we progress in life, we need to focus more and more on abundance mindset as opposed to, scarcity mindset. And not really focus on frugality that much, because let's face it, I don't think you should be living frugally your whole life. I mean, it's a personal opinion and it comes down to discussion. Different people will say, well, I disagree with you, and you can do so many things for free. There are great things you can do for free, but really you can't. I'm just going to let you know that there are so many things that are worth paying money on and experiencing once. You don't need to buy a Lamborghini, but it's wonderful to go and spend a huge amount of money and take all your friends to a racetrack, and then all of you to race around with hot cars and try to beat each other, and maybe even, have a safe, in a safe environment, have a crash and somebody laughed at somebody else. These are wonderful experiences and memories that you can't buy with frugality. You can't go sailing through the Mediterranean islands. You can't go and skiing in Switzerland with your friends and snowboarding or something like that. Maybe some people live in Aspen and they can do that, but a lot of us can't go to Bali and then hire a beautiful villa and have a birthday bash on the cliffs, watching the ocean crash into the cliffs and have a fantastic thing. And, you can't also do various adventures. Like, you can't drive around the world in your 30s. You're going to need a certain amount of money and a certain amount of passive income to do that. And frugality alone is not going to get you there.
Correct.
So I think also when you start to get some success under your belt, I think the psychology needs to change, obviously, towards an abundance mindset and not living below your means anymore. You should be living within your means. And I think it should be removing frugality. I'm not arguing against frugality for the sake of argument. I'm just trying to say to people, spend a little bit on yourself, help other people around you. It's not all about maintaining that savings rate and becoming so obsessed about it, And at this point in time in the conversation, because I've started with the building blocks first, this is going to sound counterintuitive. It's going to sound contradicting to a degree. But what most personal finance gurus aren't good at is advising you how to live a fulfilling life. And that's what I'm also trying to say from my own experiences. I've traveled to 70 countries around the world. And I became a multi-millionaire while doing it, starting from nothing, and I've done it through business and through investing and through real estate and through trading, and I've lost money and I've made mistakes, and businesses went bankrupt, and I worked in the mining sector. I lived in 8 different countries. I've invested in Vietnam and in Czech Republic and in the UK. You can go on and on. But I've had a wonderful experiences and journeys while doing all of that. And I didn't, it costs money to move and to travel and to see things as well. And thank goodness, because that's the money that I've spent. It has incredible sentimental value to me. If I just focused on my saving rates and frugality, and stayed around of a 300-kilometer radius and never seen another country or another culture and just drove in a van and did things on a budget, I look back and I said to myself, well, I don't think I've had a fulfilling life because, you know, especially for me, other people might say so. That's fair enough. Each to their own. But as a kid, I always used to watch Indiana Jones. I was fascinated how he would be a teacher in a university or a lecturer, and then on the weekend he'd just put on his hat and his leather jacket. He'd be on a plane, and next thing you know, he's in Venice or he's in India, in Nepal or in Shanghai, or you know, he's gone to Australia or he's gone to Latin America to Mexican temples or something. It's incredible, you know. So I think that's very important. And as my father always used to say to me, make sure you enjoy each and every decade, including your 20s, 30s, and 40s. You know, financial commentators and advisors, they're only focused on that special number called 65. Like, oh, I'm going to get you to this retirement 65. It's as if you're sacrificing and running after money your whole life, and then you arrive at that level at 65, and now you can do all the wonderful things that you on your bucket list that you're not meant to do. I don't think it works like that. I think people would end up with a huge amount of regret. So there are certain things that we're designed to do in our 20s, in our 30s, and that's actually the best time to do them. So attempting to do them later on in your 50s and 60s, when your stamina is low, when your interests aren't there anymore, you know, like I'll give you an example. I've traveled last year to all around Europe with my parents, and I took them on a trip and I paid everything for them. And it was a wonderful experience. And we stayed in Paris, and me and my girlfriend, what we do is we cycle through the whole of Paris, and it's an incredible experience. So I wanted to also walk with my parents because they didn't want to cycle. Well, because my father is 60 and my mom is 57, they're not going to walk more than 7 blocks. After 7 blocks, you've already done like 5,000 or 6,000 steps, and they're tired. They want to sit down and have a coffee or a lunch or something. You can't do the things at 60 that you can do as a young man or a young woman, you know, and also life changes, and you end up, if you don't do those things at that age, you probably will end up with some sort of a regret. I'm of an opinion that also, apart from the abundance mindset, which I think is very important in growing your income, because look, you're not gonna get there living life to the fullest if you're saving on a $5 coffee or a $15 pizza or skipping a holiday or something like that, same in $2,000. You're gonna get there too late when, in my opinion, you're 60 and you're not 35 anymore. Now, it's not easy to become financially free as early as possible. I understand that, but people should try to, even though they're on a trajectory to eventually get to financial freedom, people should understand the concept that the utility of money declines as we age, and that it is far less cooler and I think far less adventurous things that are left out that we can actually do with money at that age as opposed to at the age of 60, you know. So there's certain things that you need to do that are really interesting, really cool, really adventurous, really intense, that you're not going to be able to do as you age. So the message that I'm trying to deliver here, you know, in a short period of not discussing it over many, many hours and going back and forth with important things, is that, you know, you have to have a balance. You know, I've taken both sides, and you should be ambitious. You should focus on your finances. You know, you should discipline your spending, especially at the start. You should have some part of frugality that you're doing and saving for the future. Yes. We tick all those boxes, but you should also live in the moment. You should be present. You have to do the things on your bucket list that you're meant to do at your 30s and 40s. Spend a little bit of money. You know, there's a saying that time is money. I can't do it. No, actually, that's what poor people say. Rich people say money is time. They don't say time is money. Like Warren Buffett wouldn't say time is money. Warren Buffett would say Warren Buffett was talking to Charlie Rose years ago. He said that he has like, I don't know, billions and billions of dollars. He said if he could buy an extra year of his life, he would spend $1 billion to buy it. So he values 1 year of time for $1 billion. And most of us will never even collectively get to that amount of money. You know, so there are certain things that you shouldn't leave until retirement. by that time, even if you're lucky to be alive, you probably won't desire to do them, and you could potentially end up with regrets. And that's my biggest worry. I want to help people live a fulfilling life. The purpose of achieving financial freedom is not to count zeros and to be the richest guy in a cemetery, end up with the most zeros at the end when you pass away. The purpose of financial freedom, at least to me, is to live a fulfilling life and have a fantastic adventure. And I know that needs to be done more so now when I'm younger than when I'm older. There's wonderful things to do at every age group, but I would still say yes. It's important to be disciplined with money, but also don't forget to use that money and live a fulfilling life. That's my view on personal finances.
Okay. And I was curious about one more thing. You are a very avid reader of books, right? So I wanted to understand, I wanted to know what your top 3 recommendations of books for generally people who are beginning their journey in terms of financial freedom and also in investing and all. So which 3 books impacted a lot in your career?
Sure. Especially when it comes to the purpose of finance, when it comes to the purpose of money, when it comes to the purpose of achievement. When you're starting out, you said, I'm not going to give the recommendations of books if you already have financial freedom or something like that. When I started out and I was thinking about all this stuff at 18, the 3 books that changed my life, Think and Grow Rich by Napoleon Hill was an incredible book that really got my mindset in a right direction. I think this one everybody mentions, Rich Dad, Poor Dad by Robert Kiyosaki, really got my mindset in the right direction. I mean, when you're 18, simple books like that open up the door to many things. Reading that kind of a book now, it's okay, it's just kind of touches the surface. It doesn't talk about a lot of things. But that's what's needed at 18. That's not probably needed at 40 when you already have some kind of success. And then finally, the book that probably is the most honest portrayal of accumulation of wealth, the benefits that wealth brings, and also the waste of time that the whole game is of accumulation wealth, is Felix Dennis's book, How to Get Rich, which is a fantastic book, which is a really brutally honest book about wasting your time pursuing money. But if you do decide to do so, what's the best probabilities of doing it and what kind of benefits you get from it. And yeah, it's an incredible book for a young person that's starting out. So those are the 3 books that I would recommend. And those are the 3 books that I read around the time when I was young, and they had a biggest impact on me.
Okay. And one more thing I wanted to ask was when it comes down to real estate investing, like what you do with your partners, what is the minimum capital level that one should aim to look at to start doing the things that you do?
Yeah, fantastic question. So I think it comes down to personal preference. But one of the wonderful things that are happening in 2020 is that for such a long time, private markets were a boys' club, specially connected bunch of people who shared deals between each other. That was kind of closed, required huge ticket sizes and massive relationships with your investment bankers in Switzerland and things like that had the only keys to getting these investments done. And, people thought, well, shares are the only way for me to do things, and I can't really participate in those markets. And in 2020, that's not true anymore. That doesn't mean that alternative investments are a great way of investing. They have a massive range of outcomes, far more than index funds. You can make far more money, I guess, just like stock picking, or you can lose a lot of money. Deal selection is very important, but in today's world, you can find mezzanine debt investments through certain crowdsourcing, not those websites and platforms, but you can even find deals where they will let you invest 20,000 euros or US dollars. Or I've been part of multifamily deals in the US, like San Antonio or Georgia, where they've invested, the minimums were 50,000 US dollars, but they were raising millions, you see. So you can come in with a big ticket or a small ticket. So things have really changed. So you don't have to have a huge amount of money anymore on Western standards anyway.
Okay.
Relative to what you used to. But typical deals that we do, ticket sizes between 250 to 500,000 on the lower end, and then several million on the higher end. And we don't really bet that much money unless we very, very much like the deal. But we do put that kind of money into our own deals where we have full control and we don't have any leverage.
Okay.
So yeah, that's basically that. I also think the second part of your questions is when should you consider it? You don't ever have to consider it. You can always stick to index funds. You can always stick to the stock market. You can always stick to your own family business or a business that you create. Most people, most of the people that I've met around the world, I haven't yet to cross path to a person who said to me, yes, I made all of my money in the stock market. Yeah. I've met people who managed a fund and then they got a cut out of the profits, but that's not out of the stock market, you see, that's out of the fees. And I met people who made money in alternative energy and who made money in family businesses and manufacturing. I've met people who became wealthy because they had a very good salary as a banker or a lawyer and they were a partner. But I've yet to meet a person specifically who said, I did it through investing. I've met people who made money in real estate because the leverage can, if you get it right, it's quite stable, especially in the Anglo-Saxon countries. And you can make some serious money in residential and commercial real estate, sometimes rather quickly if you know what you're doing. And there's plenty of examples of that. But I've yet to meet a person across my path that says, yes, I just started with $10,000 or $20,000 in the stock market and I became super rich because of blah, 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 blah. Warren Buffett is one of those, but his initial stake was made managing other people's money and getting a huge bonus once again.
Correct.
So I think stock market vehicle is the simplest way to invest, but investing in general is not the purpose of the game. If you want to acquire wealth and if you want to do it before you're 65, let's say in your 30s or 40s, you get to financial independence earlier, I think it's about business. I think it's about adding value to the world and adding scarce value, I should say, to the world and doing something that other people are not doing or doing something that other people are doing, but then you're doing it better. Okay. It's more about business. People who really get somewhere is because they had a chicken farm or they had a traffic controller company in the mining sector, or they had a soybean farm in Argentina, or they did renewable wind farms in Western Australia, or they renovated other people's homes and built their own projects and sold them off. By the way, every single one of those examples is a real example of my client and my family. I didn't just make them up. So all of those examples are real. I never really crossed the path of a person who just said, yeah, I made all my money investing in the stock market. I'm sure there are a handful out there, but the probabilities are not stacked in your favor. So I would say focus on business or focus on mastering a skill and getting a massive salary. Save a decent portion of that salary, and then you can invest into the stock market, and then you can invest into other things like, let's say, alternative investments, real estate, and so forth. But yeah, focus on producing some type of value first.
Okay. And recently, real estate investment trusts have been, getting popular in India. For those who don't know, can you just sort of give an overview of what this predominant difference is between REITs and what you guys do?
Sure. So I don't know the laws in India specifically, but if we talk about Western countries, Anglo-Saxon countries and so forth, like your typical North America, which is Canada, US, UK, Australia, and so forth, these kind of investments, REITs are not real estate. REITs represent real estate. They're pieces of paper that give you ownership, units in a trust, and they give you the cash flow distribution and so forth. But they act like the stock market. They have the volatility of the stock market because they're mark to market priced on a daily or a minute by minute basis. And that automatically removes one of the advantages of real estate, which is illiquid. People love that about real estate. They don't want to worry about its having red or green candles and changing in value every day. Ask any old investor in real estate. That's what they love about real estate. That doesn't mean that there are no benefits to REITs. Each of them has pros and cons. Like REITs have the liquidity, but real estate has the tax advantages. Real estate is taxed very differently to REITs. Depends in which country, of course, as well. Real estate, real real estate, I'm calling it real estate as opposed to paper REITs, also enable you to have control. Like when we own our own multifamily unit block of 4 units or 6 units or whatever, if we own our own luxury apartment, we have control over that. We can finance it. We don't have to finance it. We can refinance it. We can sell it. We can buy it. We can, we can pay down the debt and reduce the leverage. We can increase the leverage. We can benefit from the tax benefits. We can add value to it. We can force appreciate it even when the market prices go down. We have all this control over it. We can negotiate in deals. And somebody says to us, well, it's worth 5 million. We say, no, it's worth 5.7. And then we can get, just through negotiations, we can increase the returns that we get or the profit exit. You can't do that with REITs. And also when we have a crisis, real estate didn't crash during coronavirus, it went up. Yes, the volumes are dry and so forth, and some places suffered, and commercial real estate suffered relative to residential and so forth. But, self-storage didn't, and industrial property didn't, and so forth, which Amazon uses as an example. Yeah. So there are headwinds and tailwinds for different parts of the real estate market. But REITs, they move in correlation 1-to-1 with the stock market. They started tanking the same way.
Okay.
And some people, and I said myself as well, some people will say volatility is not risk. Well, fair enough. If you buy something and you have the mindset not to be affected by volatility, or if you buy it and put it in a drawer and forget it, that's fantastic. Then volatility won't affect you. But the statistics are that volatility is risk, and most people sell at the bottom and buy at the top.
Correct.
And that's the truth of it, because they don't have the education that we do and the things that we're discussing here. So yeah, generally speaking, I would say REITs are at best, I would say they're a hybrid, but really they're just an exposure to the real estate sector in the stock market. They have nothing to do with real estate, in my opinion. And the two actually don't correlate often a lot between themselves. REITs are controlled by the macro algos and all kinds of other things. No one's going to be trading your real estate with an algo, and it doesn't change value like that. The bank has to appraise it. So there's many benefits that real estate has. There are certain also benefits that REITs have over real estate. But generally, when we are getting exposure, we are getting exposure to real assets. So real estate. We don't need exposure through the REITs market. That doesn't mean that REITs are not a good way to invest. I think American REITs have done fantastic. Self-storage has performed, I think, outperformed the market, the broad S&P 500 over the last 20 years easily. Asian REITs have also done very, very well. In Malaysia, in Singapore, in Hong Kong, in Japan, in China, and probably even in the future in India, because it's a new, young, growing economy. And I think it could be a smart way to get exposure to these very big buildings that are churning out huge amount of cash. You have to do your research and you have to know what's going on. But generally speaking, just in summary, for me, REITs are not real estate. Those are two different asset classes.
Okay. So one final question to you. What would be your top 3 advices to somebody who is starting out just now, maybe in his 20s, in this area? Let's say it could be real estate, it could be the stock market, it could be anything else, but on to his or her way to financial freedom. What would be your top 3 advice?
Okay, so first of all, I'll start with a side advice. As I already said, if you want to reach some type of financial freedom, you don't necessarily have to become a trader or a real estate investor or a stock index investor like I did, all of those things and whatnot, and investing in agriculture. You should just mainly focus on starting your own business or building a better career or something, or developing multiple streams of income, something that maybe we didn't touch upon in personal finance. Any way, shape, or form that can get you to a higher level of net worth or to bring more income home. And you should try to optimize that as much as possible. Later on, you can start investing. But if people predominantly have the passion, they're very passionate about these fields and they want to be an investor, they want to be in real estate or the stock market or something like that, then the pieces of advice that I will give them, first of all, is we live in an age of abundance. This is the first advice. I would say there is an information fatigue out there. I just have to emphasize that. There are sources of information coming from all sides and everybody's convinced that their way is the best way to invest. You know, you got growth investors who will tell you stock picking is the best way because it's performing well right now and over the last couple of years. The value stock pickers or the index fund guys will tell you their way is the best. Commercial real estate guys and house flippers will tell you their way is the best. Venture capital guys swear by their way. Everybody out there is telegraphing something. Your job, starting out in your 20s, just as a teenager entering your 20s, is to try to figure out who to learn from and what is the best source. That's what I would say. You really have to figure out what is the best source. I mean, I think there is a fantastic quote, by the way, that summarizes all of this by Bruce Lee. And I think this is fantastic. When I look back on my life, and when I look back when I was 20, I wish somebody said this to me and drilled this to me. And by the way, listen to this carefully because I believe this is fantastic wisdom for a 20-year-old. Bruce Lee said, adapt what is useful, reject what is useless, and I believe he said, and add what is specifically your own, or add value to what you're developing. And that's what I would advise 20 or 30-year-olds to do. Adapt to what is useful, reject what is useless, and then add specifically your own. That's the first piece of advice. And the other piece of advice I would say is you probably will go a long way if you find an incredible mentor. Like I was very fortunate to have a very good mentor in real estate, on top of having my father as a mentor as well, in business and real estate as well. And I think that goes a long way. When you asked me how I started initially in real estate, I said to you, well, I just grew up in a real estate family. I had my father as a mentor. I just skipped all that learning process that people have to go through. And I was just automatically taken into deals and on sites and on construction phases. And just, I was just brought into the family like that. And it's an incredible way to learn. You just leap over so many people and so much competition, and you start so early. So if you're fortunate enough and your family does something like that, pay attention. If not, find a very good mentor. So those are my 3 pieces of advice. In summary, potentially focus on business and don't do investing. But if you really love it, understand who to learn from, the right sources, like Bruce Lee said, and then find a very good mentor.
Okay. Thank you for the entire session, Tiho. It's been a wonderful session, and I myself learned a lot about real estate investing, and generally the personal finance related advice is brilliant. So thank you for spending some time for this.
Oh, absolute pleasure. I'm glad we had this chat, and let's do it again sometime. Thank you for following me on Twitter. I wish you a very, very pleasant rest of the year. Stay safe, stay away from coronavirus, and wishing you all the best to you and your family.
Sure. You too, Tiho. Yeah. Thank you. Bye.
Thank you.
Yeah.
Bye-bye.
Bye.